Today we are going through a spectacular trading strategy taking place only on the 15-minute time frame using fair value gaps, which has very specific rules which I'm gonna go through them with this presentation. My name is Chris, I am a six-figure funded trader and I'm helping traders become funded every single day. Let's now begin with this free strategy. Here we begin with our strategy, which is taking place only on the 15-minute time frame. As we said, this is very convenient for those of you who have daily jobs and you cannot scale down to a lower time frame. We will first begin with a bullish example and then I'm gonna go ahead and show you a bearish example as well. And before we go ahead and proceed with this presentation, I want you to check out what is going on with this pattern right here. What you see is a push, then a push below, and then a break with a change of character, which leaves two fair value gaps behind it. Okay, remember that. One fair value gap between the low of this week and the high of this week, and another one between the low of this candlestick and the high of this candlestick right here. Let's now go ahead step by step and show the rules of this amazing strategy. And if you like this setup, this PowerPoint presentation setup, tell me and I will be making my videos like that. The rules are very specific, guys. We need to see this candlestick which does the push. In this occasion, this is this candlestick right here. It happens to be a bearish candlestick. It could have been a bullish candlestick as well. Remember that. Write those rules down because you will see the precision of this strategy. This candlestick anyways, the highest candlestick, needs to leave a wick above it. No matter if this candlestick would be bullish or bearish as it is, the important thing is that it does have a wick. So the highest candlestick of the push in this bullish example needs to have a wick above it. Step by step, you can come back, scroll back to your video and check out those rules again and again. Now, the candlestick that we see over here, which is the lowest candlestick, this is not a very specific rule, but it is a rule that you need to see a push down, which implies that this has grabbed some liquidity from the past. Here there was some form of liquidity that was grabbed aggressively. So we do have two rules until now. We have a candlestick on the push up on the bullish example, which has a wick, and we have a candlestick on the push down which grabs some form of liquidity, and we see that because it goes down and it retraces straight ahead, and if we would go down to a lower time frame such as the 1 minute, those would be tiny bars, and then a break above. You would first see strong bearish bars which would be followed instantly by bullish bars. Okay, this wick right here that you see. Remember this rule as well. I will keep moving forward. Now, we need to see, as a third rule, an aggressive push up, very aggressive push, which breaks structure. And our structure is this high right here. I cannot highlight it enough times. This is a high because it is higher than the high to its right and higher than the high to its left. You extend this one to the right, and this one gets broken, and this is our break of structure. Now, if you are a struggling trader and you want to take your trading game to the next level, then feel free to join any of my exceptional services. I am a six-figure funded trader, and changing from CFDs to futures was the best decision of my life. I'm doing Nasdaq, S&P and crude oil, so do not ask about Forex. I'm not doing any Forex anymore, even though in the academy I have a bunch of lessons also on Forex. Okay, so go ahead and join the exceptional signals or the mentoring or even the academy, whatever you want to join if you want to get funded like me. Here, this was our first rule, guys. This was our second rule, and this is our third rule right here, which was saying an aggressive push-up which breaks structure. Let's now proceed. More rules. This is our fourth rule, guys. This is the fourth rule. And the fourth rule says that there should be a wick above candlestick number 1. Okay? And the fifth, let's say, rule, even though this is not absolutely necessary, this could have been without a wick, it says that there should be a wick below candlestick number 2. Now, the wick of this candlestick number 1 and the wick of candlestick number 2 together, what do they create? They do create the so-called king order block. Okay, this is why I'm saying that this is quite important, even though we're not going to be taking the trade from any of these points right here, but there are specific reasons why I want you to add those rules. Okay, let's move forward. It is important, I'm saying, that wick from candlestick number 3 does not touch the wick of the bearish candlestick A. Okay, and the bearish candlestick A is this candlestick right here, guys. This is A. I forgot to type it down. It is this candlestick right here. Let's see. There you go. I have placed the letter A, thank God. So this is the top of the wick of candlestick A, and if I extend that to the right, this shouldn't fall upon the wick of this candlestick. If this would have happened, if this wick would have tapped here, then the setup is absolutely invalid. Since this has not happened, our setup is absolutely valid, guys. We are free to go on. So we move forward right here. What do we do on the larger picture? As I said, this is candlestick number A from the previous slide, and this is number 3, where we said that if we extend this one, the wick of candlestick number 3 shouldn't fall upon this wick. You see it right here zoomed in, and then you see it zoomed out. We extend the horizontal line from the top of the wick all the way to the right, and if you don't know how to do that on your TradingView platform, you choose the line tool, you place it on top of this candlestick, you click on shift and hold on shift, and then stretch it all the way to the right. Okay, this is exactly where we will be placing our entry, the top of this candlestick. And let me tell you right now, if you have seen people talking about support and resistance, this is the only time, pretty much one of the only times, that support and resistance would work. So this one right here would work now as support, so resistance would become support, as they call it. Okay, let's move a step forward. What about stop loss? What are we going to be doing about our stop loss? Is the stop loss going to go all the way down here and sacrifice this beautiful move? No, it is not. Stop loss is going to go below candlestick number 2. There are lots of rules, and I decided to start creating my videos using PowerPoint. It is way easier, especially for beginners to understand, but also for many of you guys. I would love it personally if I would see a presentation in PowerPoint, but if you say in the comment section that, Chris, this is garbage, I don't like it, if there is a lot of you who say that, I'm gonna change it to the old school style. Okay, candlestick number 2 is this candlestick out of the 3, those 3 which are creating this fair value gap. Okay, we are not referring to this fair value gap right here because we don't care about this one. We care about the one which overlaps with this wick right here. So below candlestick number 2, we are placing our stop loss. Simple as that. Where are we taking our profits? Our profits are going to be taken at the top of this leg. Okay. or you can check the daily time frame or the hourly time frame just for the profits. Only for that. There you go. This is how our trade would look like, and this would give you a 5.25 to 1 reward to risk. Those are the exact rules. The entry would be here, and the stop loss would be right below this area if you extend that to the right, and the target is all the way up here. I hope everything is very clear until now, and if you need to ask anything, this is why we have the comment section. I am always here to respond to any question of yours. And if you want to be part of the money making team, where I'm doing presentations of 40 or 50 slides per day in the signals, then go ahead and enroll and use your code SIGNALS30 for a 30% discount. We only have the lifetime service for the moment. Okay, let's move forward. Or, as I said, you can target further areas from a higher time frame. We talked about it, such as the daily time frame or the hourly time frame. How would that look? Because this whole thing is on the 15-minute time frame only. Here is the very same trade, but now we are targeting this swing high over here. Same entry as seen from the 15-minute time frame. Same entry, but now as seen from the 1 hour time frame. It is the very same entry, guys. Okay, but now we are on the hourly time frame for the very same entry that we took on the 15-minute time frame. And this one, if I recall correctly, if I can go a step backwards, this one gives around 12.6 to 1 reward to risk, if I recall correctly. So you managed to get this 5.2 to 1 up to a 12 or more to 1 reward to risk. This might be a little bit confusing. How would we use that on a bearish example? This is why, my lovely traders, I have dedicated the time to create the bearish example as well. And you will see the very same thing happening exactly right here, and we will go through the rules again and again and again. You can pause the video, you can go back, you can check those things again and again. Feel free to do so. There we go. We begin. This is now the lowest candlestick, which leaves a wick towards the downside. And I will highlight that again, as in the previous example. We do not care if this candlestick right here is bearish or bullish. All we care about is that this is the lowest now candlestick on this push, okay, which also should have a wick, and it does have a wick, as you can see. Okay, let's move forward. And then we have this quick push up. It is not as impulsive as the previous one. That's why I said this rule is not the most important one, but we have a quick push up followed by a quick break. This thing grabbed some form of liquidity for sure on a lower time frame. Now, the important thing is that we see impulsive candlesticks which are breaking structure, and we do have that. And as you can see now, we don't have such a large wick over here because anyways we don't really care about this part of the wick. Let's see what we do care about. There we go. Those three candlesticks create our fair value gap. I decided to put this rectangle, no, it's not a rectangle, however this is called, and include those candlesticks within it so that you will know which three candlesticks are creating the fair value gap. The high of this candlestick and the low of this candlestick, the area in between that has not been tapped, is our fair value gap area in this bearish example. Now, let's go ahead and move on to the rules. The first rule that I did not include was, again, but it was that this candlestick needs to have a wick, or maybe I'm mentioning it in a bit I do not remember. This candlestick should be having a wick, and it does have it. Furthermore, candlestick number 1 out of the 3 that created the fair value gap, out of those 3, candlestick number 1 should have a wick below it. Candlestick number 2, this is not absolutely needed as a rule, as we said, but it is even better. Candlestick number 2 has a wick above it. I wanna see this king order block. I don't know what it is about it. I'm not the algorithm. I didn't create the algorithm. I have seen that it increases the probability for some reason. It is important that wick, I'm saying it again, from candlestick number 3, which is this wick over here that you see, the tiny wick over here, does not overlap, does not touch the wick of the bearish candlestick A. You remember this rule? If we extend that all the way to the right, it is important that here we wouldn't have a large wick tapping on this wick of this one. Then our setup would have been invalid, guys. Let's see. It is not touching, of course. There is a huge gap between the horizontal line of this wick and this wick, so we are good to go, as I'm saying. Let's proceed then. We extend the bottom of the wick of candlestick A, again, all the way to the right. And what did we say, guys? Where is our entry gonna be? This is our entry point. You remember that? Exactly that is our entry point. Let's proceed. The stop loss, where is it going? If you recall, above candlestick number 2. Okay, not all the way to the top, not above number 1, above candlestick number 2. And this is exactly how it looks like. You extend those two wicks, this was candlestick number 1, this is number 2, and this was number 3. So the entry goes at this wick that we extend towards the right, and candlestick number 2, which is this huge candlestick here, we extend the top of it towards the right, and we place the stop loss either right above it, or you can leave a little bit of space as I did right here. This is where the entry goes. Stop loss above candlestick number 2, guys. Now, the take profit again could be this point of liquidity or this liquidity as seen from the 15-minute time frame, and you see it is quite huge if you pay attention. Exactly like that it looks like. Okay. Now, you can also target liquidity from a higher time frame, again, as we said, such as the hourly time frame. And you see, we would have turned it to this win. From this win, which is already exceptional, we would have turned it to this huge win exactly right here, guys. Okay. The RR went here, I have the statistics, from a 7 to 1 to a 12.8 to 1, guys. So feel free to either target here or close partials along the way, or target whatever you want to target. I'm always telling my students that this is absolutely subjective. Of course, I'm teaching them exactly how I'm trading, which needs a lot of experience, and this is how I'm passing the one account after the other, and I have come to this point where I'm a 6-figure funded trader and I'm increasing my account balances steadily. And if you want to learn more, go ahead and enroll in the signals, where we are doing presentations such as this one almost every single day now. I'm not stopping with the presentations. I'm creating 40-50 slides every single day. This is value for money. I'm not just throwing an entry and an exit. And guys, let's be honest, this type of entry and exit, as you might have noticed on your own from other signals groups, this will barely work. If you go ahead and join signals who are trading, who say this is a support or resistance, and we enter here with a stop loss here, you will barely hit your targets. And when you hit your targets, it will be fine, but most of the time you will be losing. Let's be absolutely honest. I'm very sure that you share the very same experience. I have cracked the code and I'm showing you how to take profits along the way and how, even if a move, let's say, would go against us, how to profit even on this move right here while keeping your risk way lower than your reward. You will see if and when you join. And this is gonna do it. This was our fair value gap strategy, which will get you funded. And of course you can use that only on the 15-minute time frame as I showed you, and for targets you can go ahead and look at another time frame such as the hourly or the 4-hour or the daily time frame. I would really appreciate it at this point if you subscribe to the channel and like this video, share it with all of your trading friends and family. Maybe somebody wants to begin with trading, you never know, you motivate the next millionaire maybe. Check out my exceptional services as I said, and comment down below any questions that you might be having. This is gonna do it for today, traders, and thank you all for watching. Until next time.